Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us again. Please don't forget to like and subscribe and click the bell so you get a notification of when we're releasing a new video. I'm sitting again on a very, very chilly morning with Michael Porter.
Morning, Robin.
As you can see, there's been some commentary about we haven't been too bundled up recently, but now we are properly bundled up because it's cold outside. But Michael, one thing that's not cold is the property sector, isn't it? We haven't really specifically talked property for a while, but that's blazing hot at the moment.
Absolutely, Robin. Yeah, it's certainly hotter than the temperature. Yeah, it's amazing, Robin. I mean, we've been talking about listed property for a while, and actually in our Insight seminar in the middle of the year, we had some slides where we really thought we were on the cusp of a much better period for listed property. And that's come through in spades in the last sort of 6 weeks to 2 months. Like we can't believe it. Listed property is up 8% this month. Yes. It's up 20% for the year on a price basis. That's not a total return. Total return is probably closer to 24%. Yes. So by far the best performing asset class out of the South African sort of sector so far this year, and it was last year as well.
Yes, I've noticed that I was looking through some of the charts, and some of the old favourites that really hurt during COVID, some of them are above back higher than they were pre-COVID.
Yeah, Robin, I think it's going to take some time for some of the companies to get back. There was some permanent damage done, and balance sheets have had to be repaired. Sometimes companies had rights issues at low prices that have diluted some of the earnings. So things like Growthpoint maybe peaked at 30 Rand, maybe back in 2017. Yeah. I think it'll struggle to get back there. Yes. But if we consider that something like Fukile probably peaked at 21 Rand at the peak of the property cycle. It got down to 5 Rand in COVID. It's now trading very close to 18 Rand. Yeah. There's been a massive recovery. Nepi's at a high, a post-COVID high. Yes. Not every company is, and some of the building blocks still need to fall into place. But what we always say to investors is that the market looks ahead and it discounts what's coming, and by the time you read it in the newspapers, the market has moved substantially if you're not positioned for it. Yes. To be fair, it's quite actually hard to buy listed property now when it's rallied so hard in the last 2 months.
Yes, yeah. So, Michael, one of the things you highlighted in that Insight presentation was this virtuous circle. One of the things that you said was that listed property companies couldn't raise capital because with your share price depressed, you're almost giving it away, and it's costing you too much to get capital. That's turned on its head considerably, hasn't it? Are we going to see some of these property companies raising some cash?
Definitely, Robin. So it's very hard to raise capital or to issue shares when you're trading at a big discount to your NAV because you're diluting your existing shareholders and you're kind of diluting your whole portfolio. So companies don't like to do that. I don't think that NAV is the be-all and end-all. I think companies can do it, but it's hard for them to do it. Okay. Also, it's obviously hard to raise debt capital when interest rates are at record highs and you're paying away a lot of interest. Yeah. Now, both those are turning. So with share prices rallying hard, I wouldn't say there are a lot of companies trading at a premium to NAV, but the discounts are a lot narrower, and some are trading at a small premium. So it's much easier to raise equity capital. For the first time in 7 years, you can really go out there and raise. I mean, companies have raised equity capital in the last 2 years, but now you can you can get more bang for your buck. And that obviously makes the whole cycle of acquisitions a lot easier. If you can raise capital at a cheaper rate, then your return on your acquisition becomes so much better. In addition, obviously we're seeing interest rates falling. So while the Reserve Bank hasn't actually dropped interest rates yet, bond yields have come substantially lower. Right. JIBAR is already factoring in that rates are turning over. Yes. So Fukile, for example, raised debt capital last week at the narrowest spread over JIBAR in its history. Sure. That means the premium over JIBAR that it has to pay to attract people to its debt. And I think it's just a signal that there's appetite for good quality debt, but also that that interest rates are coming down. And so, companies are raising money. There's a lot of pre-close updates going on at the moment. There are a lot of results coming out at the moment. And almost without a shadow of a doubt, Robin, the mood is that things are improving. Certainly since the GNU, property companies are by and large saying that they are seeing increased demand for space. There's obviously a return to the office. There's big companies that we need some more space, whether it's warehousing, whether it's office space. The retail side is still doing pretty well. The absence of load shedding is allowing companies, well, they're not spending money on that, so they're recouping some of that. Resilient, for example, which is 35% of its electricity needs come from solar, is making money because solar is very effective when there's no load shedding. You're making money. So all these things that have been headwinds for so long are kind of coming together and providing some tailwinds. So the last, interest rates are coming down. Obviously, the Reserve Bank needs to formally cut interest rates to get that sort of cycle going. But I think the market's looking at a combination, Robin, of lower financing costs, which is earnings accretive. They're looking at lower vacancies, which is earnings accretive. They're looking at rents holding up and possibly rising a little bit as opposed to being in this downward cycle. And all together, and you're looking at now at the possibility of acquisition-led growth, which is obviously always good for companies where they can grow. And you're taking all that together, and suddenly the listed property sector is a lot more exciting. Plus, there's not a massive amount of liquidity, Robin. The sector has shrunk. And if people want to get involved in property, it's not as if there's billions of shares out there and issued,
Yes.
So, it's there's a bit of a scramble.
Yeah. Well, Michael, it reminds me of a little presentation I did during COVID that went out, property is dead, long live property. So thank you for giving us that insight. Thank you for joining us. Don't forget to like and subscribe, and we'll catch you next time. Bye-bye.